Have you ever really stopped and wondered how your bank actually makes money? I mean, we think of them as these safe places to park our cash, right? But they're also incredibly profitable businesses. So today, we're going to pull back the curtain and look at how all that profit is generated, usually quietly and consistently from people like us.
Just look at this number for a second. $270 billion. That's how much interest income U.S. banks pulled in 2025 alone. I mean, that is just a staggering amount of money. So the big question is, where does it all come from?
You'd probably guess it's from huge corporations or super rich investors, right? But here's the twist. The vast majority of that income comes from ordinary, everyday customers. From you, from me. So how in the world does that happen? That's the puzzle we're going to solve today.
All right, let's start with the absolute foundation of the banking business model. This is the main way banks have made their money for, well, centuries. And it all boils down to one really simple idea.
It's called the interest spread. Now, it sounds a little technical, but I promise the concept is super straightforward. A bank pays you a tiny interest rate to hold your money in an account, and then they turn right around and lend that exact same money out to someone else at a much higher interest rate. That gap, that's their core profit.
And you can see just how massive that gap really is. On your savings account, you're lucky to get less than 1%. But when the bank lends that money out on a credit card, they're charging over 20% for a personal loan, maybe 8 to 15%. See, they're not lending their own money, they're lending our money and just charging a huge premium for the service.
Okay, so beyond that main engine, banks have pretty much perfected the art of making money from all these little, almost unnoticeable charges. You know, things that add up on a massive scale. Think of them as slow, quiet drips that eventually become a flood of income.
And yeah, at the very top of that list, credit cards. They are, without a doubt, one of the most profitable financial products ever invented. U.S. credit card balances are now over $1 trillion. It's this huge market, and its profitability is really built around one little feature, the minimum payment.
And this is where that minimum payment system is so brilliant for the bank. It's designed so that when you carry a balance, they benefit the most. If you only pay the minimum, the interest just keeps compounding on the rest, your main balance shrinks at a snail's pace, and you can easily end up repaying double or even triple what you originally spent. And then, of course, you've got the penalty fees. Come on, we've all been there. A small miscalculation, and you get an overdraft fee. Or you use the wrong ATM. In the moment, they just feel like these small, annoying little charges. But how much do those annoying little charges add up to? Try tens of billions of dollars every single year. That's what U.S. banks rake in from just overdraft and penalty fees. It really shows you that the profit isn't from one big mistake, but from millions of us making tiny, repeated oversights. But wait, there's more. The profit centers don't stop there. There's another one that is completely invisible to almost all of us, and it has everything to do with timing, or what the banks call the float.
Okay, so here's how the float works. When you deposit a check, it might take a day or two to officially clear. In that little window of time, the bank takes your money, pools it with millions of other in-transit funds, and earns interest on the whole pot. But when you make a payment, that money is gone from your account instantly. You don't see it, you don't feel it, but when you multiply it across the entire banking system, it becomes a huge source of income.
So you've got the interest spread, all the fees, the float, but what really ties all this together is a deep understanding of human psychology. This isn't just about spreadsheets and numbers, it's about our behavior. And this is a really crucial point. The system isn't really built to prey on people who don't know anything about finance. No, it's built to monetize predictable, totally normal human behaviors. Banks study how we act, and then they design their products around our natural tendencies.
You can see this so clearly in behavioral economics. As humans, we almost always choose the convenient option over the best one. We put off making complicated decisions, like refinancing a loan, and we are just terrible at mentally calculating long-term interest costs. So banks just design their products to fit perfectly inside those habits. So, this brings us to what I think is the most important part of this whole explainer. Now that we get the mechanics, how do we change our relationship with them? Well, it really comes down to a choice. Are you going to be a passive participant or an informed user? And let's be super clear here. Banks aren't evil. They're for-profit businesses, and they're operating completely legally. The real issue isn't that banks exist. It's the widespread lack of financial education about how these systems actually work. And this slide really breaks it down perfectly.
The passive user, they just carry credit card balances month to month, they overlook those little fees, and they never read the fine print. But the informed user, they get the game. They pay their balances off strategically, they monitor their accounts, they use the bank as a tool intentionally instead of just letting it happen to them.
This quote really just says it all, doesn't it? Banks don't make money because people are bad with money. They make money because the entire system is designed to reward inattention. Their profitability is directly tied to how closely, or, not so closely, you're paying attention.
So, it all boils down to this. Now that you've seen behind the curtain, now that you know how the system is actually designed to work, the only real question left is, which kind of user are you going to be? Because that choice, and all the savings that come with it, is completely up to you.